Welcome to the deep dive. Today we're doing something a little different. We're diving into an annual letter.
Right. Not usually the most thrilling source, maybe.
Exactly. But this one, trust us, is special. It's from Giverny Capital, their 2013 letter, which actually marked their 20th anniversary.
And it's much more than just performance
Oh,
figures.
yeah. It's this, fascinating mix of results, sure, but also their core investment thinking and even some really deep thoughts on, human behavior.
It really is. Almost a masterclass in long-term strategy.
Mhm.
And what I found interesting is how they use it to teach their partners, their investors. They even include art, like that photo Giverny you mentioned.
Or Selassie one. Yeah.
Yeah, it sets this tone, doesn't it? Like patient gardening, not frantic trading.
Totally. Patient cultivation. So that's our mission today, to kind of pull out those key ideas, those nuggets that can help you think better, whether you're into investing or just, how long-term success actually works.
Sound good? Okay, let's unpack this. So maybe start with the numbers, just to set the scene. 20 years of the Giverny portfolio up to 2013. What did that look like?
Well, the headline numbers are pretty impressive. For 2013 itself, the portfolio returned 50.2%.
50.2.
Yeah. And that beat their benchmark by 11.3%. But maybe more importantly, the long-term view.
Since inception.
Since inception, July 1st, 1993, the compounded annual growth rate was 15.5%,
Okay.
compared to 8.3% for their benchmark. So that's an annualized outperformance year after year on average of 7.2%.
Which beats their own target, right? Didn't they aim for 5%?
Exactly. So they're comfortably ahead on that long-term goal.
And they break it down regionally too, U.S. and Canada.
They do. So the Giverny U.S. portfolio, that's all in U.S. dollars, it returned 40.6% in 2013,
Okay.
which beat the S&P 500's 32.4%. So outperformance of 8.2% there for the year.
And long term for the U.S.
Since 93, that U.S. portfolio did 15.7% annualized. The S&P 500 did 9.2%.
So about 6.5% added value per year. Right. And they point out that 2013 was the sixth year in a row they beat the S&P.
That's consistency.
It is. And then there's the Canadian portfolio.
Which started later, you said.
Yeah, focused on Canadian stocks since 2007. In 2013, it returned 49.4%.
Almost 50% again.
Compare that to the S&P TSX, the Canadian index, which did 13.0%.
Whoa, that's a huge difference.
A massive 36.4% outperformance for the year. And since 2007, the annualized return was 17.5% versus just 3.7% for the benchmark.
What drove that Canadian performance? Any specific names mentioned?
Yeah, they highlighted a few key holdings. Valent Pharmaceuticals was a big one, up 96%. Dollarama up 50%. MTY Foods up 54%.
Okay.
They do note it's a very concentrated portfolio, though, not many names. So it doesn't really track the TSX index much, which, leads to these big swings in relative performance, both good and bad, presumably.
Right, makes sense. So these are obviously stellar results, especially that 50% in 2013. How did they explain that? They called it the triple play, right?
Yeah, the triple play. It wasn't just one thing, they broke it down. Okay, so about 15% came from the actual earnings growth of the companies they owned, plus another 1% from dividends. So that's 16% from the businesses themselves doing well.
Got it. Business fundamentals.
Exactly. Then the second part was the market re-rating their stocks. The average PE ratio went up from 14 times earnings to 17 times.
So sentiment improved, people willing to pay more?
Right. More confidence, basically.
Yeah.
And the third piece was currency. They got an 8% tailwind from the Canadian dollar falling against the U.S. dollar.
Ah, okay.
And they make a point of saying, look, this wasn't just luck. They felt valuations had been kind of compressed before that, partly due to the strong Canadian dollar between 2006 and 2009. So this was things getting back to, let's say, more normal levels.
Interesting. But then right after showing these amazing numbers, they warn you not to expect this kind of thing going forward.
Yeah, they're very clear about that. Extrapolating 50% returns is, not realistic.
So if it's not about chasing last year's winners, what do they say is the absolute #1 driver of long-term returns?
It boils down to one thing for them.
Yeah.
The increase in the intrinsic value of the companies you own. Full stop.
Intrinsic value. Okay.
And they lean heavily on Benjamin Graham here, the father of value investing.
Obviously, intelligent investor.
Exactly. Graham's idea that in the short run, the market's a voting machine popularity contest, irrationality.
Yeah.
But long term, it's a weighing machine. It reflects the actual value.
So they're focused on the weighing machine.
Completely. They want to know what the businesses are truly worth and how that worth is growing over time.
And they use a specific measure for that, right? Buffett's owner's earnings. How does that work?
Right, owner's earnings. They estimate it pretty simply.
Right.
Add the earnings per share growth rate to the average dividend yield. That's their proxy for how fast the intrinsic value is growing.
Okay, so EPS growth plus dividend yield.
Yep. And then they show this fascinating chart or comparison. Since 1996, the companies they owned grew their intrinsic value, by that measure, by 867%, which is 13.4% annualized. Now, compare that to their actual stock portfolio return over the same period, 903%, or 13.7% annualized.
That's incredibly close. 13.4% versus 13.7%.
Almost identical. And they say, look, this isn't a coincidence. Over the long haul, the market performance does track the underlying business performance.
So their outperformance isn't market timing or sector bets.
Primarily, no. They argue their 5% edge over the S&P 500 over 18 years comes because their chosen companies grew their intrinsic value about 5% faster than the average S&P 500 company. It's business selection.
That's a really powerful point. It connects to that analogy they used too, the one about bridge.
Ah, yeah, the bridge analogy.
Bridge.
Nicholas Lequia, he's on their team, 6-time Canadian bridge champ.
Right.
And he talks about how in bridge, you need a plan. You make the play that has the best mathematical chance of succeeding, even though sometimes, it just doesn't work out. The cards fall badly.
So apply that to investing.
It means have a clear philosophy or process. Stick to it because it gives you the best odds over time, even if you have losing hands or losing years.
And they had that 60-40 rule.
Yeah, the 60-40 rule. In bridge, they say, even the best team playing the best strategy might only win about 60% of the time against a decent opponent playing randomly, who gets 40%.
Okay.
Giverny applies this. They looked back. They underperformed the S&P 500 in 6 out of their first 20 years. That's 30% of the time.
So roughly in line with that 40%. Or their own rule of 3, expecting underperformance 1 year in 3.
Exactly. And accepting that you will be wrong maybe 30 or 40% of the time, is crucial. It builds psychological resilience. You don't panic when a good strategy has a bad year.
That makes sense. You bake it into expectations.
Right. Nicholas would say persistence beats luck eventually.
So while they're focused on this long-term value and process, they're also aware of dangers, right? They talk about the flavor of the day. What were they seeing in 2013 that worried them?
Yeah, they definitely keep an eye out for, let's call it, overheating sentiment. In 2013, they mentioned bonds losing value, gold being way off its highs. Even things like the Canadian dollar and housing prices may be coming back down to earth. But the big one they flagged was tech stocks.
Which one specifically?
Names like Facebook, Netflix, LinkedIn, Tesla. They acknowledged, look, these are great companies, often with fantastic CEOs. But they were trading at just enormous PE ratios, an average of over 100 times earnings for that group.
100 times earnings. Phew.
Yeah. And they mentioned Twitter, too, just gone public, not profitable, but already valued at $30 billion. The concern was the price being paid detached from fundamentals.
So, great company, potentially dangerous stock price.
Precisely. Which leads perfectly into their podium of errors. I found this section really fascinating.
Me too. The honesty is refreshing. What were the big misses they highlighted?
And importantly, they focus on errors of omission, things they didn't do but should have. They think those are often costlier.
Okay, so what got the bronze?
Bronze medal, TripAdvisor. They liked the company, loved the brand dominance, but they hesitated. They saw a price drop, thought maybe it'll get even cheaper, waited, and the stock shot up 180% to $84. They missed it waiting for that perfect price.
Ouch. Lesson learned. Perfection is the enemy of good enough.
Something like that. Then, the silver medal. Buffalo Wild Wings.
Okay.
There was a dip in earnings. Chicken wing prices spiked temporarily.
Yeah.
They thought about doubling down. They believed in management's plan.
But they didn't act.
Didn't act on the conviction. And the stock doubled again in about 15 months. Missed opportunity.
So conviction needs action.
Exactly. Which brings us to the gold medal error.
The biggest one.
Church & Dwight, the Arm & Hammer Trojan Condoms Company.
Right.
They saw the growth plan, loved the brands, knew the management team was brilliant by 2003. Everything lined up.
So what was the error?
They just kept waiting for the stock to pull back to a more attractive entry point. Kept hoping for a dip.
And it never came.
It never came. The business just kept executing. EPS grew 17% a year for a decade. The stock went up 455% in 10 years. And the PE ratio actually expanded.
Wow. So they identified a winner, but just couldn't pull the trigger on the price.
Exactly. The conviction was there, the analysis was there, but the action wasn't. Fixated on a price that the market never offered again.
That speaks volumes about temperament, doesn't it? Which they also discuss relating to the 2008 2009 crisis. They did a 5-year look back. What was their takeaway from living through that?
Oh, that was a powerful section. Remember, 2008-09, people were genuinely questioning if capitalism would survive. Panic everywhere.
Right.
Giverny, they didn't panic, stayed 100% invested. They were actually buying.
Really? In the thick of it?
Yeah. They even went public, did a newspaper interview calling it the opportunity of a generation, tried to rally investors with a website, conferences.
Good at work.
Apparently not much. They said they got hardly any registrations for the conferences. People were too scared.
So they were acting against the herd instinct.
Massively. It really highlights Peter Lynch's point, doesn't it? That the key organ isn't the brain. It's the stomach, the ability to withstand fear.
That resilience is incredible. And it leads them to this really out there idea, maybe. The missing gene hypothesis. What's that about?
Yeah, this is where they get quite philosophical. They ask,
Right.
what really makes the difference for investors who consistently outperform?
Okay.
Their suggestion is you have to do something different from the crowd, which means you can't be swayed by what everyone else is doing or thinking, especially during panics or manias.
So you need independence of thought.
Deep independence. And they quote Buffett, wondering if maybe this ability, this temperament, isn't entirely learned. Maybe it's partly innate.
Innate. How so?
Well, their hypothesis, and they admit it's just a hypothesis, is that maybe these successful outliers lack something the rest of us have, a kind of tribal gene.
A tribal gene. Explain that.
The idea is humans evolved in tribes. Sticking with the group meant survival. So when the tribe panics and sells, our instinct is to panic and sell too. Safety in numbers.
Right. That makes evolutionary sense.
But maybe, just maybe, some people lack that gene or have a weaker version. They don't feel that overwhelming urge to follow the herd.
So they can stand apart, like artists or scientists who pursue their own vision.
Kind of like that, yeah. They can go against the grain, buy when others are fearful, sell when others are greedy, because they don't have that intense biological pull towards conformity.
It's a fascinating, if unprovable, idea. What's the takeaway for us then?
Well, even if it's not literally a gene, it's a powerful metaphor, isn't it? It helps explain why firms like Giverny could stay rational and disciplined in 08-09. It highlights that psychological dimension.
Right. It reinforces that Buffett quote, be fearful when others are greedy and greedy when others are fearful. Maybe some people are just wired differently to be able to do that.
Perhaps. Or maybe understanding the tribal pull helps everyone else resist it better.
That's a good point. So wrapping this up, this deep dive into just one annual letter has been, well, pretty revealing.
It really has.
It shows that long-term success in this field, it's not just spreadsheets and forecasts. It's about a core philosophy, sticking to it.
Having that patience for intrinsic value to play out.
And crucially, having the psychological strength, the temperament, to act independently, especially when things get crazy.
Absolutely. And their own top 10 lessons learned section kind of summarizes it all.
Yeah, treat investing like owning a business, not playing a game. Focus on management, competitive advantages.
But the core principle running through it all is, don't try to predict the short term, it's futile.
Focus on finding great businesses, run by great people, bought at reasonable prices.
That's the winning recipe, as they call it.
So maybe the final thought for you, the listener, is this. When you face a tough decision, maybe a financial one, maybe something else entirely, think about that tribal gene. Do you feel that pull to just go with the flow, do what everyone else is doing? Or can you step back, rely on your own plan, your own thinking, maybe with a little bit of that Giverny humility too?
Something to definitely think about long after this deep dive ends.